Hey folks, thanks for joining me today on this challenge where I'm trying to make a 50% return on investment in just 1 year. Now, last week was week 7, and I managed to increase my returns by $95 from 1649 to 1743. Most of that value came from the options that I sold, which was almost $400 last week. But the actual stock price of Google did go down by about $3. And we'll first take a look at what happened last week because it's quite interesting since I was expecting my option to be exercised, but it was actually not. So this is the beginning of last week, and I sold a call at 115 and I sold two puts at 108, meaning I want Alphabet to close between these two purple lines. And this is what happened. This red bar represents Friday. So that was when my option expired. And you can see it actually ended just below the purple line. Here's a screen capture from Yahoo Finance on the Friday of the close. Alphabet closed at 107.85, so that's below the 108 strike price. But then even in after hours trading, the stock went up a little bit, but not past 108. So I was expecting both put contracts to be exercised. However, neither did, which is a good thing for me because the beginning of this week, Tuesday, since Monday was a holiday and markets were closed, this is the first trading day of the week. You can see that Google is actually down. So I definitely got lucky there. And somebody else, the option buyers, got the short end of that stick. I'm not sure why they didn't exercise. Maybe they thought Alphabet would go up first thing this week. In any case, that was my first experience of having an option go in the money, but not have the option get exercised. So anyway, let's see how I can take advantage of this by using the lower price today, because Alphabet is down about 0.5%, and kind of use this opportunity to earn more premiums with my options, especially the put options. So I think what I'll do this week is, looking at the pattern here, we're going up and down, and right now we are at the bottom of this highlighted pink channel, and we've actually broken through the channel. You can see we're right below the line here. So I think what's most likely going to happen is we're going to get a bounce back up, which means I would be expecting higher price targets from here, especially by the end of this week. Now there is a short-term trend kind of going this way, as you can see, and this channel is still in play. It's continuing. So there is a chance that we could go lower to maybe here and touch the bottom of this mini channel before going back up. And we really only have 3 days since yesterday the markets were closed. So we have 7, 8, and 9 left, which will take us to roughly this point over here. So because I think there is more upside potential than there is downside, I think the lowest we might go, just looking at this green line here, is probably around like the 104 mark, somewhere around there. And for my call, I'm going to move that down to maybe around the 113 or 114, somewhere around there. So I'm going to hop over to the option chain for Alphabet here. This is inside Interactive Brokers, and turn on Strategy Builder. Okay, so let's do the call option first. Over here, I can see this is where the 2 standard deviation is. And that's only 6 cents for $15. Okay, 8 cents for 14, 13. So I might go with this $13 here. This will give me a 7.8 delta. I'm going to sell that call, and then for my put option, I'm actually going to do something a little bit different this time. I will split my put options, and I am going to sell one put option actually at the money. So the stock price is currently at about 107, just a little bit below that. So I'm going to sell one at the money, 107 put. But then what I'll do is I will sell another put at maybe like 106. And what this will do is spread out my risk across multiple strike prices. So if Alphabet ends the week at like 107, then maybe this one will get filled, but this one will not. However, if it goes way below to like 103 or 102, then instead of getting 200 shares at 107, I'll sort of average down my cost basis because I'll also have 100 shares getting filled at 106 instead of buying another 200 shares at 107. Yeah, let's see what this will look like in terms of the profile. Okay, so this is pretty much what we're looking at, profit probability. So there's a 66% chance, 2 in 3 chance that this will be profitable. And by the end of this week, which is the 9th, this is the risk profile for this particular strategy. So as you can see, if Alphabet remains above 104.82, this break even on the lower side, then this trade is profitable. And if it stays below 116, then this trade is also profitable. So that's a pretty wide range, and that's where the 66% comes in, which is basically one standard deviation of where Alphabet can go. So I kind of like my odds here. If the stock does go lower, like towards the left here, you can see how this slope is steeper. And I'm okay with that because if I have to get assigned the stock and it drops like 102 or 103, that's totally fine. Because in 1 week's time, if Google drops to that low, then that would be like the deal of the year. And I don't think it'll stay that low for very long. And if the stock price goes higher, you can see the slope is not as steep. So I could even buy back my cover call and close my position if I don't want to get rid of my shares. But there's only like a 7% chance the stock price will go above my call strike. So I'm not too worried about that. Okay, so let's see how much money I can make out of these options here. For the price, quite a bit. This is in US dollars. I'll have to convert this to Canadian later. But let's say 360. Submit my order. And that should come in here.
Order filled.
Oh, and it just filled. Right there. So I basically purchased one strategy, which is selling a put at 107, 106, and then also selling a call at 113. And over here in the trades, you can see with a total commission of $2, so that's $358, not too shabby. And you can see most of that came from the 107 put because it is at the money, right? So that's the advantage of selling an at the money option is you get paid a lot in premiums. And then the least premium I got was from the covered call with a strike price of 113. So maybe I should have waited a little bit this morning before putting in my trades because the price of Google has been dropping. If we take a look at the last hour, it's just been falling more and more and more. So actually, yeah, because I was selling 2 puts and just 1 call, I should have waited for the stock to at least like halted its downward momentum. And in that way, I can make even more premiums from my puts. But anyway, let's input in the numbers for this week, which is week 8. So at $358 US, multiply that by the current exchange rate of 132. That's $473 in premiums. So this week, I'll have to update this at the end of the week, but assuming it stays, let's say around today's price, 106, and I drag this down, so that's how much premiums I've made in total, then my cumulative returns would be 2,236, which is about 11% year to date. So after 8 weeks, with 11%, that's pretty good. I think by week 50, assuming the same return momentum, I should be able to get to a 50% return on my initial 20,000 capital. So we'll have to see. And of course, one of the good things about selling puts and making money from premiums is as the stock price drops lower, you can see 110, 107, 106, the premiums get higher. And the reason for that most likely is because of the implied volatility. You can see it's also going up. So I bet today Google is at over 40% implied volatility. Let's take a look. Yeah, IV 42.5. So round that up to 43 here. You can see in week 2 when IV was 74, I made a lot of money from options, just selling those puts and calls and getting the premiums. Anyway, because I sold an at the money put option, there is a good chance that I will be buying more shares of Google this week. So let's see what happens. Thanks for joining me today, and I'll see you back here next week as usual.